Welcome to Channel 17, the Town of Colonie Government Channel.
Hello and welcome to The Money Factor. I'm Richard Naylor, your host. Today's show is going to be on the economic climate or the investment climate. The last time we talked about that, the situation was a bit different. In March of 2009, the Dow was at 6,500. I'm really happy to have our guest back again, Frank Marchesini from Edward Jones. He's been a frequent guest on the show, and it's always good to get a little update. So I want to welcome you back, Frank.
Thanks, Richard. Nice to be back again.
You're kind of somebody with the feet on the ground. I get excited.
Well, since we were together last, we have even made more progress in the markets. And I appreciate the opportunity to come back and kind of shed some perspective on what's going on and what we recommend to folks that are investing their money.
Well, I know it didn't last long, but the 6,500 was enough to make people really afraid.
Well, absolutely. It was basically a 50% decline in the market, which has happened in the past, but it hasn't really happened in over close to 35, 40 years. In the early 70s, a lot of people just completely lost faith in all components of the market, and it was a bad time. And obviously, we're still feeling the effects with the recession.
One of the things that we often hear from people who have experience is that you need to keep a long-term perspective. But I think a normal person will wonder at different times, well, should I have sold? I mean, if only I had bought at 6,500. Why didn't I sell at 14? But how should we look at it?
Well, it's everyone. It's easy to look back in the rearview mirror and think I should have done that, should have did this, or why didn't I do that?
So I guess, is it cheap now? That's kind of the question too.
Well, let me address that. Right now, the Dow is, if you look at how it's valued, as you know, stocks are valued against their earnings. And stocks actually right now, even though they're more expensive, they're valued more reasonably than they were a year ago, because at the time the earnings projections were lower, and since then companies have improved their earnings and have shored up their balance sheets. So the Dow right now is trading at a price earnings ratio of about 14, where a year ago it was at 21. So right now stocks are valued fairly.
It's hard to believe that was a year ago. That was, as you pointed out before the show, that was March of last year.
March of
And here we are, April. So it's only been 1 year since
Right.
the deepest depression.
Right. We've gone through a lot of things that we've never seen in our lifetime, but we still have work to do. We still have to correct the unemployment situation. So there's a lot of folks out there, still feeling the pain.
Let's go, I guess, before we look ahead. What lessons can we learn from that? I guess you could say that was a bear market, but it was almost like a cliff market.
Well, it was an extremely bad or rough bear market. I guess the lessons learned is that bear markets do occur. I mean, they average every 6 to 7 years. This one happened to be much worse than what we normally see, and they begin and end without warning. No one can really predict with certainty. So, what we continue to preach is that you have to be prepared for these things. They do happen. The time to make investment decisions and sell investments is not in the middle of a bear market. That's the worst time. So what we're recommending to folks is be prepared. Have a strategy. A strategy isn't trying to predict when the next downturn is going to occur. Use principles such as owning good quality investments, being properly diversified. Have a strategy in place so you're prepared, and then stick with the strategy. Because investing is about it's a cyclical business. And if you can't take the cycles, then you shouldn't have your money invested in the market.
On the other hand, like I think you've said before, inflation can be a problem. And right now, with interest rates low, although I'm not sure exactly where they're going, it's hard for people to find a place to put their money.
Well,
under the mattress is definitely not very safe.
The folks right now that are feeling the effects of where we are right now are the folks that have a bulk of their money, or have typically had a bulk of their money in shorter term investments, meaning CDs and money markets. And because of what's happened out there in the marketplace, those rates are virtually at zero right now. And there's a lot of reasons why, but one of the things that the federal government does through the Federal Reserve is they regulate shorter term interest rates. And the messages that the Fed is sending out is that they're not going to see increases in the rates they control for another 6 to 8 months. So what that means to folks that use banks is, hey, your CD rates are going to be low, your money market rates are going to be low, and for folks that need more income, that's a struggle. So they have to find other ways to make up that shortfall.
And I suppose at this point, people are either kicking themselves that they sold at the wrong time, or they're just wondering what to do. So let's go back to those lessons and maybe try to apply a couple things.
Well, one of the things that we could touch on is in the area of fixed income investments. And when I consider a fixed income investment, I think of things like CDs, but also things like bonds. And we also look at fixed income in terms of the length of commitment or maturity. And you've got investments that are shorter term, let's say 0 to 5 years. Then you have investments that are 5 to 15 years. And then you have longer term investments, 15 plus.
Now, if they're 15 plus, I would assume that's something that you would be possibly trading or selling at some point.
Well, maybe not, though.
Maybe not.
It might be something you potentially would want to be holding for the rest of your life.
And maybe through several cycles.
Correct.
Okay.
Correct. But the idea is that no one knows for sure where interest rates are going. So rather than trying to predict and having all of your money in a single kind of investment waiting for rates to change, we recommend that you have dollars diversified across those different maturity buckets, so to speak, so that no matter where rates are, you're doing the best you can to diversify yourself. Because right now, there are 6% investments out there in good quality bonds. And for somebody that's sitting in a money market with 100% of their assets, they're missing an opportunity to get some higher income. Again, that's just, might not be suitable for that person, but that's something they should look at.
Now, if you're 25 years old or 30 years old and you're being smart and you're investing, I assume you'd be much stronger in stocks.
You should be. One thing that you certainly have as a 25-year-old that you don't when you're a 65-year-old is you have a lot of time ahead of you before you're realistically going to be using your assets for income. So a 25-year-old would have the luxury of being able to work through many ups and downs that will be coming for them in their lifetime. And when you're in an accumulation mode, when you're adding money to your account consistently, it actually helps when the markets are down. You're getting more bang for the buck, so to speak. So young folks should be consistently adding to their accounts and not allowing the market volatility really to change their plans significantly.
Yeah, that's kind of neat to visualize. If I think about a graph and maybe the Dow or the S&P and where it is over 40 years, then I don't feel so bad if for 10 years, say, it's not going up much. If I keep buying them at the same amount and think, well, eventually profits are going to be big enough that people are going to say, well, this is silly. We're starting to pay dividends now, and then the prices are going to go up.
Right. I guess, for someone that is working and investing in their employer-sponsored plan, a 401k, they should continue to just focus on adding incrementally and really not allowing the market fluctuation to change that plan. Because ultimately, you're trying to build an asset that's going to replace your paycheck down the road. So essentially, you're saying, well, I no longer need as large a paycheck when I'm retired, so I'm going to stop adding money now. I mean, people are making those decisions based on the wrong.
Yeah, that didn't seem like that wouldn't be a wise decision.
But a lot of people did. A lot of people stopped contributing to their retirement accounts because they saw their statements going down. And, you know, that's the nature of being invested. It's a cyclical business. It always has been, and it probably always will be.
Now, did you see that happen when the market was at 14,000? Or were they, maybe you could say, greedy and putting it in then because they're saying, look what's happening to money, I'm going to put more in?
Right. Well, you tend to get people that act on extremes and emotions. And I've said this to you in the past. The two most powerful emotions in investing are greed and fear. And when markets are soaring, people think that it's never going to end. And that obviously is not the case. Things do fall eventually, and that's generally what fuels that run is euphoria and just, you know, the exuberance that things are going to continue to be good. And on the flip side, when the markets are dropping, it tests your patience, it tests your courage, and people tend to capitulate to the fear and they sell. And, you know, history tells us that good markets do follow bad. They don't last forever, but they're really difficult to go through.
Now, we looked at the younger person, the 25-year-old, and I don't want to leave the fixed income quite yet. What if you're 60, 65? What if you're 70 and you're retired? How do you think about the fixed income there? I know inflation could be a challenge, so stocks maybe shouldn't be out of the picture, but how do you think about it?
Well, for retirees, it is a challenge because there are two things that are working against them. Is that people are living longer, so their assets have to last a longer period of time, and the other thing is inflation. So you have to be able to keep ahead of inflation, and particularly with seniors, they are exposed to highly inflationary services, particularly healthcare, prescriptions. So you can't become too conservative because you could eventually run out of money if you're not careful. But you can't be too aggressive in your investments either, because if you have another downturn, then you're seeing your account values drop. So it really is a balancing act. And you know that's where honestly you should get some professional help if you're not working with someone, because there are ways to protect income. There are strategies that you can put in place to hedge, and it is more challenging for seniors, for sure. But having all of your investments in a single, type of an asset, a CD or money, usually that's not going to cut it.
So for a senior or maybe somebody 50s, the three-bucket principle would be very good?
Yeah, absolutely. I mean, that's something that I consider for most of my clients that are over 50. Again, depending on their situation, but you have to have money available in short-term markets because it's accessible, it's generally protected, it's safe. Right now, it's not earning anything, but there isn't anything wrong with considering having some money in longer-term investments that, yeah, the market could fluctuate on those and the value could change, but they're paying a fixed rate of interest that, in some cases, you're getting 5-6%. That's not bad either.
So that would be the long-term, the longest
Those
term?
are the longer-term investments, sure.
And that would be 6%. Seems like it's fairly a nice average historically. Well,
it depends. I mean, that seems to be right now for a a longer-term investment. If it's a government bond, it might be more in the 4.5. But if there are issues from municipalities or corporate bonds, they're paying 5 to 6% right now.
Okay. And I suppose the short term, you can always then terminate that at some point and put it into longer term if that every month income or however often they're paid is very important.
Right, that's right. You could reposition some of that money into something that's paying a higher rate, and that's where having the right percentages in the right buckets, so to speak, it depends on your needs. And
so you really need a budget. You need to know how much you're going to need out of those as you go along. And I was thinking, you were saying that we're trying to replace our paycheck, which I've always thought about that, but our paychecks tend to go up while we're working, and after we stop working, they don't go up the same way.
Right.
So what paycheck do you replace? The one that you would have at 75, or the one that's 65, or when you're near?
Well, you're going to have to replace as close as you can your very last paycheck that you earned from your employer.
And that's
because retirement planning, a big part of it is what type of a lifestyle do you want to live in retirement? And if there really is going to be continuity in your lifestyle, then you're going to have to somehow replace the check that you just got from your employer with either one that's provided through your investments or a combination of your investments, a pension, Social Security, but the total has to equal what you were bringing in while you were working. Otherwise, something's got to give, or you're not going to have any excess.
Right.
So.
Yeah, to me, the idea that I can live after retirement on quite a bit less than I did before doesn't sound very appealing, because we like to travel.
Well, that's true. Most people, though, don't have the same expenses that they're incurring routinely. Mortgages tend to be paid off.
Right, people
Kids
tend to own their homes.
be through college. So, the rule of thumb is we usually say try to produce 80% of what you were bringing in while you were working as a good rule of thumb.
Okay.
Some people it could be less, some people it might need to be more. It depends.
Any other lessons from what we just went through? And the neat thing about that, it seems that right now we should have a pretty clear idea that things can change, because we just went through that.
I guess just the point, and I made it earlier, is prepare now. You should be preparing now. Your portfolio needs to be prepared for the next time the market goes down. And again, nobody knows for sure when that is, but preparation is absolutely essential. You don't want to own anything today that you wouldn't be willing to own during the next downturn.
One last question, which I don't want to beat too many dead horses, but how do we avoid any other help? How do we avoid making rash decisions? Because I've seen that happen where somebody just panics. It's a string on our finger,
Turn off the TV set. I mean, a lot of people are so fixated on the 24-hour market channels.
Every day, right?
All
the time.
Every day, or hearing the news. Generally, the news tends to be, focusing on the negative. And I would just say you have to sit back and look at the plan and your strategy and say, okay, is there a reason I need to change my strategy? What's going on right now that causes me to make an adjustment? It has to be based on more rational thought. I know that's easy to say during a crisis, but to just say I open my statement and see my account value continuing to drop is not in and of itself the reason you should.
Okay. And I'm sure that there's no ultimate answer here, but that's probably the best strategy.
It's not easy, but
right.
but that's preparation is key.
A lot of people are talking about the deficit these days. We've just gone through a very difficult period. Both administrations worked on bailing things out. The housing crisis, the banks started it. But the deficit is very large, and everybody agrees to that. What is that going to mean to our investment horizon, our portfolio?
Well, I'll answer it this way. The fact that we have a larger deficit right now would mean that you need to consider the impact of a few things on your portfolio. Number one, the presumption that tax rates are going to go up. I don't know that with certainty, but we should plan like tax rates are going to go up. And if that's the case, you should be looking at options that would help you defer taxes through retirement accounts, defer the growth on your investments through retirement accounts. And then also another way would be considering things like tax-free bonds, where the interest that you earn is exempt from taxes. So there's no way to escape taxes, but there are certainly ways that you could reduce and mitigate the taxes.
That struck a bell here when you said municipal, because we live in New York, and our state also is not in great shape. But the bonds would be tax exempt
That's correct.
in New York.
If you buy issues,
New York
issues, they would be exempt from both state and federal
So
taxes.
even if New York raises taxes, these would be double exempt.
Double exempt, correct. Another way that the deficit could potentially impact us is through the devaluation of the dollar. And that had been a trend up until recently. The dollar's gotten very strong, but let's just say the trend is the dollar gets weaker against foreign currencies because of our deficit. That would compel you to consider having investments that are overseas, international investments, because then that serves as a hedge against the drop in the dollar.
Again, balance.
Balance. International investments just provide another level of diversification that's important. And then the last thing would be if the deficit creates some type of an inflation problem, then you would want to own some investments that are a hedge against inflation, and stocks serve that capacity. Stocks do appreciate, just like any asset during inflation. Prices go up, stocks would follow suit. And also, you'd want to look at companies that pay dividends and have a good track record of paying dividends, because those companies tend to increase their dividends annually, and that's giving you a pay increase essentially on that investment. So that's a good way to, keep yourself ahead of inflation.
Would you consider a dividend-producing equity kind of in between a bond and a no dividend stock? Or would that be a little bit...
Yeah, that's a stretch. I mean, I guess certainly a bond behaves differently than your two stock examples.
But at least you do have some way to siphon off.
It does provide some income. That's what it shares with a bond, but it doesn't necessarily behave the same way, and there's other considerations.
Right.
But again, for folks that are looking for rising income, dividend-paying stocks are a good consideration.
International. We've heard of some of the markets, Japan, China. They've taken some precipitous falls that even make our market look fairly stable, the emerging markets. How do you weigh the emerging markets versus the more developed countries, Germany, England, France, or Europe?
Well, the emerging or developing markets, those economies are still, fairly new to creating a middle class. There's a lot of opportunity for growth, but there's more risk embedded in investing specifically in those types of countries. There's more currency risk. There could be more geopolitical risk, economic risk. You can see some pretty significant gains, but you can also see some pretty significant losses in those types of investments. We recommend that when you look internationally, you also should consider that companies that are growing their businesses overseas and are taking advantage of those developing economies, those are the kinds of companies you want to have in your portfolio. Now, whether you own them outright or you own them in a mutual fund, it doesn't mean they have to be based in those countries. They could be based in developed countries, but they've got their reach and they've got their infrastructure based in all over the globe, and they're leveraging opportunities everywhere.
So from that point of view, a General Electric, that would be almost an international stock, or not?
That would be an example of one. There are companies out there that literally 75% of their business is generated overseas, even though they're based in the United States. A great example would be McDonald's. Their growth, their growth is all occurring outside of the United States. They have a very mature market here. There's countless companies that are positioned to take advantage of that global growth.
So I guess if you have stocks in a large size, what would you call that? A very large, a portfolio that's got a lot of large companies in it, as opposed to one with a lot of small caps or mid caps, you're more likely to have international.
You're indirectly getting some of that exposure just by the fact that they're doing business there. But also another way to really get more pure international is the companies are based outside of the United States.
So there's a place for that.
There is a place for that, and it's an important consideration. Again, I never want to recommend that something is suitable for everyone, but clearly we're no longer just the global economy isn't just a catchphrase. It's a reality in investing now, and you should have dollars that are taking advantage of growth overseas.
One more thing with the emerging versus developed. Do you recommend something that balances between the two, or would someone feel more comfortable with the developed countries?
The emerging or the developing market kind of investments, if they're very focused, we usually would say never go more than 5% in any one, because they do have more volatility. If you're going to be investing internationally, most folks would be more comfortable having larger developed country-based kind of investments, just because they're more predictable, and those companies have more of a level of business that's established and
it seems like, following from what you said before, if we're doing that because we want to minimize dangers of our own currency and our deficit, then that's not necessarily implying that we're trying to just get bigger returns. So the developed countries in other countries, the developed companies, in other countries, would provide that hedge against a weaker dollar without increasing our risk.
That's right. I guess what diversification does is it allows us to have investments that might perform in the opposite of, let's say we have U.S.-based companies, and we're in a downturn in our market, that international markets may improve and to help offset that. It's how you build some more stability in your portfolio, or consistency, not necessarily looking for ultimately higher returns, but most people are just looking for consistency.
I think sometimes, especially right now, we wouldn't be really out of line saying, if I got a 6 to 8 to 9% return on my investment, I shouldn't be too unhappy.
And if it was to happen every year,
right,
you'd be even happier. But the reality is that's an average. 8 to 10% is an average. And you'd be surprised at how many years go by where the actual return is not in that. It's a 20, it's a 0, it's a minus 15, it's an 18. It's, that average is a victim of the realities of the market, and that's what tests investors. is the fact that we have great years and everybody forgets about the lessons, and then we have a bad year, and people just, it's tough for them to deal with that. So you can't, we don't live in an average world.
I think that's a good place to end. I like that. So I want to thank you for being here.
It's always a pleasure. I appreciate the opportunity to come in.
And we'll get you back in a few months and see
Okay.
how things are looking.
Sounds great, Richard.
Great.
Thank
Thanks,
you.
Frank. And I want to thank you for watching. Hope you enjoyed the show, that you tune in again next time, and you have a great week. Take care.
Welcome to Channel 17, the Town of Colonie Government Channel.